How do you use risk-neutral probability in Monte Carlo simulations? Have you ever wondered how traders predict the future prices of options? One key tool they use is risk-neutral probability. This concept plays a vital role in Monte Carlo simulations, which help in pricing options. Let's break this down step by step to see how it all works together. First, what is risk-neutral probability? It is a method that allows investors to estimate future cash flows without worrying about individual risk preferences. This means that when using this approach, all investors are viewed as being indifferent to risk. This simplifies the process of pricing derivatives, making it easier to evaluate options. Now, let's talk about Monte Carlo simulations. These are powerful computational techniques that model the behavior of financial instruments under different scenarios. By generating random outcomes based on historical data, traders can estimate future prices and option values. To use risk-neutral probability in Monte Carlo simulations, you start by defining the risk-neutral probabilities. This involves calculating the probabilities of upward and downward movements in the price of the underlying asset. You can use a formula that considers the risk-free rate and the potential returns of the asset. This gives you a clear picture of how likely each price movement is. Next, you simulate price movements. Using Monte Carlo methods, you create multiple scenarios of how the asset's price might change over time. Each scenario is based on the risk-neutral probabilities you calculated earlier. This step is crucial because it sets the stage for understanding how the option might perform. After simulating the price movements, you calculate the option payoffs for each scenario. For a call option, this means finding the difference between the asset's price and the strike price. If the option is out of the money, the payoff is zero. This step helps you see how the option would perform in various market conditions. Once you have the payoffs, you need to discount them back to their present value. This is done using the risk-free rate, which accounts for the time value of money. It ensures that you are evaluating the payoffs in today's terms, which is essential for accurate pricing. Now, you average all the present values of the simulated payoffs. This average gives you the risk-neutral value of the option. It represents what the option is worth based on the expected future outcomes without the influence of individual risk preferences. Finally, it is a good idea to repeat the simulation process several times. More simulations typically lead to more accurate results. This repetition helps refine your estimates and gives you greater confidence in the option's value. In practice, using risk-neutral probability in Monte Carlo simulations is vital for options pricing. It allows traders to assess potential risks and rewards under various market conditions. By understanding how these probabilities influence option values, traders can make more informed decisions and optimize their portfolios effectively. So, the next time you hear about risk-neutral probability, remember how it fits into the larger picture of options trading and valuation metrics. It is a powerful tool that helps traders navigate the complexities of the market with greater ease.